Hey everyone, it's Sterling here from Day Trading Forex Live. It is June 4th, 2013, and what we're looking at here is a hourly chart of the dollar Swiss. Just to give a real basic overview, because probably most people listening to this video may not understand market cycle. If you don't, you can always go to the site, daytradingforexlive.com, and there's a lot of information on that. Breaks down all different parts of the strategy. If you don't understand something, or shoot us an email. Again, we'll be happy to get back with you. But a real quick synopsis of this trade, and I'm taking a trade here, or as far as the dollar Swiss, I am short from 95.01, and I want to walk through why I am. It's still basically 9,500 right now, but I want to walk through why I took the short and essentially what set it up. So what we'll do is we'll zoom into the 15-minute, and I'll show you guys what I was actually looking at. And basically what we have here is we have a high that was set during the London session. The market came up, created a fresh high, and then worked off of that high. So as it started to work off of that high, what happens when a high or a low is set is that you have the rest of the market responding to that level. And so what I mean is, if you were to ask yourself, how do people trail stops? Probably one of the most common ways to trail stops, especially in a situation like this where you have a massive drop and then you have a very clear high that is set. Anybody that's short is more than likely going to be moving their stop to just above that high. And that's a very common practice of all the practices of transitioning and moving stops to trailing beyond the previous high or below the previous low is a very, very common strategy. So in this example, when we see the market come back up, create what we term as the stop run, meaning they're taking the stops for anybody that was shorting from that high and anybody that moved their stop above that high. So again, we call that the stop run. We need to see at least a 3-pip break. And when we see that stop run and the confirmation back down, I'm not going to get into the confirming entry. It's too much to cover in a short video. But, and again, there's information on that on the site as well. But what we have here is we have a very simple false break above the previous highs, creates the stop run. It's in the direction of the overall expected cycle, which, as far as this is concerned, expecting the second push. We have a beautiful set of reversal legs. My entry point, these highs were about 18 pips away. Now, optimally, I'd want to see that pull back a little bit more. I want to see it pull back a touch closer. But in this example, we've seen such an aggressive movement on the Swissy, I just really didn't want to chance it. And so in this specific trade example, which I very rarely go anything above a 20-pip stop, what I'm doing is I'm going with a 25-pip stop. And so generally, like I mentioned a minute ago, I want to be in that 20-pip target area. And what that implies is the market needs to be within 15 pips of the high. The reason it needs to be within 15 pips of the high is because you have to factor in spread, and then you have to factor in getting a few pips above that high for your stop. So what I did here, because I wasn't sure of the pullback, which, at this point I'm kind of glad I took it because it's starting to run away right now. But the reason I went with the 25-pip stop is, again, because the large swings we've been having and a late session stop run, they tend to just take off. So with this example here, I would rather have just used the 25-pip stop and extend the take profit equally, extend it to a 25-pip take profit. As anybody knows, with our strategy, one of the biggest keys is risk reward, and that's something that we do not deviate on. And so anytime there is an increase in stop loss, you must be increasing your take profit as well to maintain the same risk reward. So anyways, that's the gist of this trade, guys. It was in the direction of the overall cycle, number one. And number two, it was a nice stop run of the previous highs. We also have some confluence with the 200 EMA being there as well. But regardless, when you see smart money manipulating the market, you can be sure that they are doing one thing, and that is, in the case of taking stops to the upside, they're inducing the buying pressure, hitting the stop for anybody that's short, therefore you have to buy it back. That's one type of buy order. Also triggering any buys on the breakout. So when you see that market manipulation, and it's a clear demonstration of the banks manipulating the market, when you see them do that, it's a very good indication that if they're inducing or if they're creating that buying pressure, why would they artificially create buying pressure? The reason they would artificially create buying pressure is to allow them to sell. Remember, if you do not have a buyer, you cannot sell. And if you have nobody that's willing to sell it to you, then you can't buy. So either way you look at it, again, if you want to buy, you need a seller. If you want to sell, you need a buyer. Therefore, because they move such massive amounts of money, they have to create that artificial buying pressure or selling pressure. So when we see this manipulation in the direction of the overall cycle, it's a no-brainer. It's a very powerful setup, a great risk reward, and this trade's no different. So I'll let this continue to run. I am not going to set a take profit on it at this point. I had one on, but I'm going to pull it off because of the fact that we're early in the cycle. So what that means is that this thing could very easily just test the previous lows, and that would still be maintained within the previous cycle. So I'm going to let this one ride. I'm going to let this one ride with an open take profit, at least at the moment, and I will update it as I take the exit. So I'll see you guys back shortly, and we'll be here for the close. Alright guys, we're back with the finale to this dollar Swiss trade. I'm coming back a couple days later. I had a lot of other work to do, some videos, some other training I was getting done. That will be on the site next week, and got a little sidetracked with that. But anyways, I wanted to do the close to this video because it illustrates one of the ways that we close at Day Trading Forex Live. And before we get in, before we go any further, if you're not familiar with the closing, again, we have a lot of information on the site about that. But when it comes to closing out the price, there's really 3 reasons I'll take an exit. Number 1, my stop or my limit is hit. That's obvious. Most people have the same criteria, obviously. The second point is that we're seeing manipulation or a stop run against the trade that we're in. So if I was short and I saw a stop run of a level to go long, that would get me out of a trade. But number 3 is something that most people don't do, and they don't give any thought to why this would be important. For London session traders, the changeover from 7:59 to 8 o'clock, when you go from just London to now London and New York open, that is what we term as a session change. And the same thing with New York. When you go from 4:59 p.m. to 5 p.m., you've gone from a session from New York to the start of the Asian session. So what's important about those session changes is that you have a whole nother set of banks coming on, and so because of that, you're subject to that next session's manipulation. And so a simple rule that we use, the third reason that we would exit a trade, is those session changes. And when I go from London to New York, what we want to see is we want to see people do one of 2 things: either close the trade out or move the stop to break even. Regardless, we have to do something to protect that trade because, again, you're subject to the next session's manipulation. So that was really the case here today with the dollar Swiss. Now, when I personally go from New York to Asia, I always close that trade out. I'm not going to get into the little nuances of why I do that. And on the flip side, when I carry a trade from London to New York at 8 a.m., I move the stop to break even. I do not close out going from London into New York. And there's various reasons why I do one from New York to London and why I close going from New York to Asia. But that was the close rule here, and quite frankly, we were starting a fresh cycle as I described in the beginning of this video. But the way I trade is based off of based off a clear pattern that has consistently worked. It's something that we're able to teach to traders because it consistently works. Now, what that also means is that there's no perfect strategy in this market. So you're not going to catch every move pip to pip, and unfortunately, this is one of those moves that really took off to the downside. And in fact, just to illustrate all the pain and the pain in this movement down, we have, let's see, just in what we can see right here, we have roughly 100 pips, and the market has continued off another 200 pips from there. So it's been one heck of a move to the downside. I can just show you the hourly real quick, and you can see the entry point was up here, and we completed the cycle, or have continued off in that cycle direction. And there was some other opportunities in there, but as far as strictly the opportunity that that I was referencing in this video and the trade that we took here initially, this trade ended up getting closed out for overall 35 pips of profit, and that was again closed at the end of the day. So one of the things that is affected at the end of the day close, meaning closing at 5 p.m. when you're carrying a trade from New York, or if you carried it all the way from London, one of the things that, and one of the only times, I guess I'll say this, one of the only times I don't care about risk reward, or it's not even that I don't care about risk reward, but because we're going in that session change, that is the one time I will close it before I hit my risk reward target, and other than a stop run against the trade that I'm in. So in this example, not the perfect risk reward that I wanted, but it illustrates a very, very nice trade. You know, guys, the banks are trackable. We are never going to know everything that they do, but when they give us the setup that we're looking for, it's just in a very simple terms, in this case, the break above the previous day's high, because we know where the retail orders are sitting, we know where the banks are likely to go to get those orders. And so when we then see the manipulation at those points, in this case, a false break of that point, it's a very powerful indicator. And when you put that whole combination together, that's just a bit of, that's just one small piece. But when you put it all together, it's just an unbelievably powerful setup that allows you to get into very high risk reward scenarios. And that's what makes it so powerful. As someone who's traded for a long time, what holds traders together, what is the glue of successful traders over the long period of time, is their risk reward. And most people focus so heavily on win-loss that they really forget about risk-reward, and that's also why at the end of the month they're not consistently making profits. And so that's what the smart money strategy does. It allows you to get into those high risk-reward scenarios. And this is just another setup that was a quality false push above the highs. Once the banks have told you what they're doing, it's a very strong probability that you're going to at least see some movement in that direction, and that's what we look to trade. Very precise, clean setup. So anyways, if you're interested in learning more, feel free to peruse the rest of the site, Day Trading Forex Live. If you're not already a member, I'd encourage you to look at our advanced training, give that a look. And if you are a member and you have any questions, feel free to shoot us an email, and we will be happy to get back with you either way, member or not. Alright guys, that's going to do it for this video. I look forward to talking with you, and until next time, happy trading.